and we're going to go into it. So a little bit about myself. I'm based here in Austin, Texas. I am the lead investor relations general partner for CREI Partners. We started this back in November of 2019. And then for the past 13 years, I've been with Fortune 150 commercial real estate firm, leading management services for about 4.5 million square feet over my tenure with them over the 13 years. I've worked with dozens of professionals with real estate. We've done a lot of capital improvement, strategic plans. So the things that we're going to talk about here later today about, value add and such, I mean, that's been in my wheelhouse and something I've enjoyed doing, again, for the last 13 years. I have an MBA from University of North Carolina, a Master in Economics from the University of Oklahoma. And then while I was in the Marine Corps, went to National University for my undergraduate. So who are we? Our goal is to help people get wealthy through real estate or diversify. And we do that through syndication. So we raise money to buy assets, money that we could not, or typically others could not purchase on their own. So we raise our money, including myself, we pull our money together. We buy value add real estate. Our markets are Austin, San Antonio, and Houston. We'll execute our property business plan, and we'll go into the strategic plans and such later in the presentation. But every property is like its own business, its own LLC. It has its revenues, expenses, net operating income. So if you can equate a business to a property, you're ahead of the game. A property is a business. Tenants are paying rents. You've got storage, you've got antenna lease, etc. All adding revenues, expenses. The higher the net operating income, the higher the value of the property, the higher the money that we're pushing back to our investors. And that goes into distributing returns to our investors. So we typically do that on a quarterly basis. And we'll talk more about that a little later with how those structures are set up. And then we'll implement our exit strategy and distribute profits. That is the end of my spiel on our company. I'm not the rest of this presentation is not about CREI Partners or myself. It's really just about educating. And really, I feel like so many people are I'm myself included, 401ks, we've got our stocks or mutual funds or our house. And we are doing, a lot what our parents did. They work 30, 40, 50 years and then they retire and, hopefully Social Security is there and all. So this is all about diversifying. It's not about completely taking your investment and moving it into real estate. It's diversifying and doing something a little different than what the majority of people out there are doing. So we're going to go into that. So there's a lot of discussion points that we're going to cover. One, we're going to start with defining multifamily. So, before we start about multifamily, we got to know what it is. And we're going to talk about why invest in multifamily real estate. What are the different reasons why a lot of people who are looking to diversify their wealth or grow their wealth invest in multifamily. We're going to talk about the types of investors. We talked about that a little earlier about active and passive investors. So this is where we're going to talk about the different two. And then hopefully you'll know or have a better idea of where you fit in that. We're going to talk about risk profiles. Everybody on this webinar is going to have a different risk profile based on where they are in life. If you're earlier on in your career, or you're early on in your investing cycle, then you may have a higher risk tolerance. You're looking to grow your wealth and okay to take more risk. Whereas somebody who is they're looking more for cash flow, you're looking for cash preservation and such. So we're going to talk about risk profiles a little later. We're going to talk about financial metrics, legal must-knows, market cycles, and then we'll close up. So it's about a 40-minute presentation. Again, it's a lot. I'm going to send the slides and the recording likely tomorrow. So you'll have that. So, and then afterwards we'll do Q&A. I'm happy to answer any questions that anybody has. And then you can also use the chat box or the Q&A. It obviously did work because you'll let me know that the volume wasn't working. So appreciate that. All right, so let's dive into it. So define multifamily. So Wikipedia defines this as this category including apartment complexes or high-rise apartments buildings. And this is what really is the important part. Generally, anything larger than a fourplex is considered commercial real estate. So anything more than a fourplex is by definition multifamily commercial real estate. So if you've got a duplex, triplex, single family, you're not in that commercial realm. You're in the residential. There's nothing wrong with that. And I started out with single family. I had a rental in California, and it did well. So that's a really good way of doing investing. But investing in multifamily is anything more than 4 units. So why passively invest in real estate? And a lot of this presentation is going to focus more on the passive investors. So, when you look at the real estate class versus, these other investments, whether it's gold, oil, 60-40, and the 60-40 is putting 60% in the S&P 500, 40% in more of the treasuries, bonds. So over a 20-year period, according to this JP Morgan study, about 9.9%, close to 10% annual returns average over 20 years. Now compare that to gold and oil and such. I mean, those are all still pretty good returns, but from a standpoint of real estate, it's a tangible asset. What we've seen over the last year is some really low lows with the stock market and some really high highs in the stock market. I was looking at my investment portfolio today, and it has not done well over the last month with my stocks. But not to say, that won't change over time. It's just very, ups and downs. Where on the multifamily and commercial real estate, it's been pretty steady, even during, all the things going on with rents and such. So I wanted to start off this slide. I mean, the biggest reason why people get into real estate investing is because it's pretty risk resilient. When we go to our next slide, of the property types. So there's obviously different property types. You've got apartments, industrial, office, retail. We could have added storage on here and hotels. But of, these top 4 property types, apartments have I would say overachieved, but it's had the highest returns over the others, from a standpoint of this 10-year holding period. And why is that? At the end of the day, people need a place to live. And that doesn't matter if you're in a pandemic, non-pandemic, if the government is, subsidizing, et cetera. People need a place to live. You've seen in the office, this is very true with over the last year, where, people are able to work from home due to technology. I don't think office is going away. I was on a call today for one of our office properties with a lot of our tenants, and not one of them talked about downsizing it's people believe that we're going to get through this pandemic and we're going to get back to the office space just because culture and other things. So, a lot of people are standing away from office, but I don't see that going away. Industrial is booming. You look at Amazon and these other warehousing, more internet purchases and such require more storage. So that makes sense why the returns are high. And then from an apartment standpoint, again, people need a place to live, rents, just because of supply and demand, location, rents tend to go up, and it goes back to that business where, the higher revenues, moderate expenses, where, you're not a slumlord or anything. You want to make sure you're maintaining the property. But all of it comes down to that bottom line. So those returns is what's meant out. So that's why I personally invest more in apartments than others. Even though I've got a lot of experience in office and retail, I just feel like from an apartment, my risk tolerance, we'll talk about that a little later. My risk tolerance is, feeling like apartments, for me, class B and C, we'll talk about that a little later. But that's sort of my personal risk tolerance. So depending on where everybody is, you'll choose something different. But another reason why people go into real estate, and it's not, I don't want to get into politics, but there's a reason why people like, Donald J. Trump don't want to show their tax returns. I dated someone in high school for most of the high school, and she went to a very, very expensive school, but she was able to get practically go to school for free, because on paper, her family, even though that they were multimillionaires, they showed like they had nothing. And it's because of this depreciation. And it's something that is legal. And it's a fantastic benefit on why to invest in real estate. So let's talk about what it is. So regular depreciation and multifamily is 27 and a half year depreciation. So if you've got a property that's $3.5 million, got to take out the land. The land, 750,000 in this instance, is not depreciable. So you take that out. So you got 2.75 million that is. When you divide that 2.75 million over, say, 27 and a half years, you get $100,000 a year on depreciation. So if you made $125,000 for that year and you depreciated $100,000 for that year, your tax liability is only $25,000 on paper, right? So in reality, you've made $125,000, but on taxes, you only have to pay $25,000. Now, what if you were getting $75,000 for that year? Remember that revenue. Well, if your depreciation was $100,000, you're not paying any tax, and you're showing a loss on paper for your taxes. And so that's how the wealthy get away with what they do with the taxes. Now, there's even more benefits with this. That's regular depreciation, 27 and a half years. Accelerated depreciation is the straight line depreciation that really allows people to do everything over, say, 15 years. So everything that's in an apartment can be, for the most part, be depreciated, right? Your cabinets can be depreciated. The flooring can be depreciated. The property itself, land obviously can't, but anything that is an improvement on the property, in theory, depreciates over time. It gets old, it needs to be fixed. So what you can do is you would hire an engineering firm, such as Madison Specs, and there's a lot of other engineering type firms that will come out and they will survey every aspect of your improvements on the property, and they will come up with a depreciation list. So instead of doing a 27 and a half year depreciation, when the likelihood of you owning a property 27 and a half years is not very common, right? Most is 5 to 10 years. So you accelerate that depreciation and say you're making, I'm put the example, 300,000 on the property, and your accelerated depreciation is 300,000, then your net, you've netted out. You don't have a tax liability, for that. For the bonus appreciation, this is taking all the future depreciation into year one. So I'm not a tax consultant. I'm not a tax attorney. You would want to talk with your tax person, but this is a huge reason why people, wealthy investors, people that just continue getting more wealthy, generational wealth, is looking at these tax benefits. This is not something that I'm hearing will go away. We hear, 1031 exchanges and such, but Congress and, they benefit tremendously from this depreciation of real estate. And again, if you have questions, put them in the Q&A. We'll go through them at the end. But I just want y'all to put them in if you have questions so you don't forget. So there's more reasons why people go into multifamily. There's a return on investment. So after all the expenses have been paid, distributions are paid directly, to the investor. Market demand, depending on the market you're in, there's not a lot of, there are people investing in New York. Land is land. They're not growing land. So people say, well, I'm not investing in California. I'm not investing in New York. There are people investing, but there are a lot of people moving to the Southeast. So Florida, Tennessee's hot, North Carolina, South Carolina, where I am in Texas, we're getting so much movement from the West. And that's not just California, it's Nevada, other states that are coming here, where it's driving up the demand. And that's huge. And you also have this declining home ownership. So you have low interest rates right now, which is great, but there's just a lot of people that don't want to own a home, which is driving up multifamily. You got this leverage, and it goes back to why I like syndication. Many of you that have bought a house, you might have used a VA home loan where you didn't have to put money down, but there are, a lot of you that had to put money down, and that money came out of your pocket that you saved over time. It's the same thing with larger multifamily. You're pulling your money to buy larger properties that you couldn't before. So in this example, a $10 million asset, you could get for a $2 to $3 million investment. And you can have equity in it, for, less than that, because you're pulling your money with others to get to that $2 to $3 million investment. The other thing that's here is depreciation and amortization. Just like your house values are going up, or if you own an office building or such, appreciation does happen, and amortization. Every time you're making that principal payment on your mortgage, both residential and commercial, you're paying down the loan. So as you can tell, there's just a lot of reasons why real estate, commercial real estate, and in particular multifamily is attractive. So we're going to talk about the two types of real estate investors. So the first is passive investors, and that's really where you're placing your capital into a real estate syndication that's managed for you. So if you don't like real estate or dealing with anything, things that can happen 3 a.m, whether it's, toilets, a flood leak, et cetera, and your passion is more on law or construction or a doctor or an IT software engineer, you're not wanting to get into day-to-day active real estate because you're busy with your day job, you're balanced with your family, you've got other passions that you're going after, but you want to still benefit from all the real estate benefits that are out there. So you take more of a passive approach, and we'll talk a little bit more on what how that really looks. And the flip side of that is if you are like me and I just had the sick passion of real estate, it's something that's been ingrained in me early in life, growing up, and every aspect of real estate investing, pretty much I enjoy. So, that is for you. If you are somebody who wants to find the deals, structure the deals, raise capital, deal with the management, deal with, ongoing asset management, and then the sale, that is, and we have investors on the call like that. That's for you. So again, this presentation is a lot more towards the passive, because it's just getting as much information out there to the passive investors who may have not have been, have looked into real estate investing before. So from a risk profile standpoint, there's really 3 risk spectrums. There's core, value add, and opportunistic. And I'm gonna start with core. Core is typically your Class A institutional type property that's really looking to lower risk. And by that, they're willing to take a lower return. So lower risk, lower return. So what does that mean? So if you're in Austin, I'll say Austin here, your Class A institutional type quality, I would say a $100 million plus asset is in a core, in that core spectrum. A lot of teacher retirement funds, there's a lot of pensions and such that are tied into real estate, and they're more investing in this core. They're looking more for consistent, stabilized cash flow, and they're okay with getting a 4 or 5% return. The key here is preservation of cash, lower risk. And so depending on where you are in your life cycle, I wouldn't say life cycle, but yeah, life cycle of investment. So if you are, looking to live off cash flow, which is nothing wrong with that. Say if you invested, I'm just going to put out $1 million, and you're at a 10% return, you're living, that's $100,000 a year on income that you can live off. So you're not looking at drastically growing wealth. You're just looking to live off that investment, that income. So when you get into more value add, and that's me personally, that's sort of where I'm at. Medium risk, medium return. This is more your Class B, your Class C, 1970 to early 2000 type property, where they are in a good area, good, say, demographics, crime area. There's a way to grow value by raising rents or changing demographics. There's a story, there's a business plan to it. Just like when you take over a business, if you buy a business or you go and invest with someone else, you're looking at, like, how do we grow value, whether it's through lowering operating expenses or finding ways to increase revenue, whether it's through rents or parking, et cetera. So there's usually a clear path to growing value. And you do that by looking at nearby properties and finding, like, hey, this property over here was able to get a $75 rent bump by doing ABC. And that type of value add can be done at this property. So sort of the middle of the line, medium risk, medium return, you're going to be getting preferred returns, say 7 to 9%. And I shouldn't even say preferred returns. I'll say, 79% returns with a 12 to 15% or more, IRR. And we're going to talk about those financial metrics shortly. Then you get an opportunistic, and this is truly a higher risk, higher return. These are your, the stocks that that you may invest with, whether that's globally or domestically, that there's just a higher risk tolerance, but that's okay because where you are in your investing path, you've got time to recover if it goes south, et cetera. And so what's an opportunistic land? That's buying maybe raw land, going through the full development permitting cycle. And what makes that opportunistic is when times are good today does not mean it's going to be good in 3 or 4 years when that property is developed. And so you're taking a risk unless you pre-lease on that. So that's an opportunistic. Or you find a property that is just complete disrepair, maybe a 50% occupancy or less, and you're going in with the mindset of finding ways to lease up the property, whether it's office, multifamily, whatever it is. But in the work that you're putting into, you will be getting a higher risk. So if you look at lower risk, lower return, think of, and I don't want to say it's less work, but I mean, you're not, when it's a Class A property, in essence, it's a newer property. So you're going to have, and it's a different demographic in a lot of ways. So you're going to have different risks than, say, than opportunistic type. So wherever you fit, there's not a right or wrong. Everybody will have their own place. And I'm spending a lot of time on this slide because it's really important whenever you start talking to deal sponsors, is where do you fit in this? So if you're more in the middle value add, you're good with, you want to return every year, but you're 5 to 7 year, you're good with a 1.8 or a 2x multiple over the 5 to 7 year hold, then value add, that's your place. If you're okay with 4 to 5% and you're looking more cash flow and low risk, then core is you. If you're just completely opportunistic, you don't care about cash flow today, but you care about, the future opportunity, that will be you. So wherever you are, this is just a good slide to, figure that out before you start investing. So some of these financial metrics here that you will hear a lot in passively investing in multifamily is cash on cash. And so simply, this is the money that you have put into the property divided by the amount of money that you get from the property. Okay, so it's a rate of return calculated by dividing the cash flow being produced by a property by the initial cash investment. So if you've invested $100,000 and you had a 10% return, then your cash on cash, or you made 10,000, your cash on cash is 10%, which is really, really good in today's investing, right? The internal rate of return, and this can get confusing, and at the end of the day, when you're comparing different investments, it's hard to know which one has the better return over all anticipated cash flows. So if you're looking at a 5 to 7 year deal compared to an 8 year deal, or compared to some stocks, et cetera, your IRR is a way to really discount all future cash flows to get a net present value of 0. And really what that means is what is your overall return when you look at all the quarterly or monthly cash flow amounts, and then you look at the sale of the property, where say you're getting a $30,000 check at the end, plus all the other periodic investments, you calculate all that into your IRR. So it's really important. In a value add, it's typically, in today's environment, it's 12 to 15%. If someone's saying they can do a value add, get 20% or more, that's really look at the market, look at what's going on. And the reason I say that is because rents right now, for a lot of us deal sponsors, we're not putting in year one rent growth, right? Because we don't know what is going to be happening in the market. We're going to be looking to retain tenants. We're going to be looking to attract residents. And so, we're a little bit more conservative. So depending on the rate of return, typically, again, it's 12 to 15%. There's a lot of people on the call that have had 18, 20, 25% IRRs, and that's fantastic. We just, I don't want to say sadly, but the times are changing where, the winds that were helping us get to that point is sort of going in the opposite direction just because of the economy. But still, 12 to 15%, even a 17% return is fantastic when you're looking at all the investments that you can invest in, plus the tax benefits and the other things we talked about earlier. The other financial metric that is heavily talked about when you'll see, when you'll get listings or opportunities is this equity multiple. So, for me personally, if it's not a 1.8x to 2x over 5 to 7 years, it's not really exciting to me. And so, this is a way for you to quickly see, what is the rate of return that I should be expecting over all the cash flows. So that's the periodic cash flows and the cash flow at exit. So if you're putting in 100,000 and you have a 1.8 equity multiple, then over the 5-7 year, whatever the whole period is, you're looking at $180,000. So these three metrics are talked about, and there's so many different blogs out there. So cash on cash, internal rate of return, and equity multiple. Those are three things that you'll want to look more into. So some target returns to investors. Everybody so depending on the deal sponsor, they're going to set it up differently. There's different ways. There's a preferred return, and a preferred return is one that the investors that are investing their money from a passive side, they're going to get that return first before the general partners. So if the property had a 7% return, then that entire 7% would go to those investors because they had the preferred return. Now, if it was an 8%, 7% would go to all the passives, and then the 1% could go to the active, or they could split it. So there's also the equity split. Okay. So if you've got the preferred, that's one way. Or you look at an equity where if you and I are investing in a deal and we say, hey, we're doing a 60-40 split, you can get 60%, I can get 40%. That is a straight up equity. If we make those returns, it's great. If we don't, then we've shared the risk in that. So I like, in our deals, we do preferred returns. I feel like those that are trusting and investing their capital, should have the preferred returns, and it allows us to work harder to get the cash flows we need. But every deal is going to be different, and we're going to talk about the private placement memorandum later. But it's important to read and know how your deal is structured. So in this case, let's say it's a preferred return. You put a $50,000 investment, and year one, we're at a 7% return. So year one, you had 3,500. Year two, you had 3,750. Year three, 4,000, 4,250. So the returns go up every year, really because there's more revenues. You've got the property more stabilized. But year five, we sell, and over that 5-year period, you've captured, from your investment of 50,000, you're at 87,500. So you've had 175% return, or an IRR rate of 17%. Your total equity multiple, when you add this 3,500, 3,750, 4,000, 4,250, 87,500, all combined is about 103,000. So you've had an equity multiple of 2.06. Those are fantastic returns. That, oh, by the way, because of also that tax depreciation, all this money that you were making, on paper, again, everybody's going to be different. Talk to your tax consultant, but for the most of us, we're not paying taxes on those cash flows. Now, at close, at sale, yes, there are capitalization taxes. There are tax considerations then, but then there's those 1031 exchanges. There's other ways that continue taking that money, shielding it from taxes, moving into a new investment, and go from there. I do have a webinar on my website, CREIPartners.com, that goes into the taxes as well. So hopefully that explained a little bit on the preferred returns versus equity split. Again, preferred returns is the passive investor is getting the priority return before the other investors. So if it's a 7% or an 8% preferred return, you're getting those returns first before anybody else splits the cash flow. One thing to note on the slide too, I put in here, is refinancing is a huge benefit, just like you would refinance your house. Similar thing in multifamily, where say you buy it at a property that had lower occupancy or lower cash flow because the rents weren't at market, and you were able to grow that over, say, 2 to 3 years. In essence, if you were able to grow the value, say, by a couple $1,000,000 over that term, you could refinance it, depending on how your original loan's all set up and such. But in theory, say you can refinance it, pay out those investors. That capital that goes back to investors is tax free, and then you're continuing, depending on the situation with the deal sponsor, you're able to continue benefit from those passives because you didn't sell the property, but you got your initial investment back, and then you're able to still benefit from the returns. A huge caveat: every deal is going to be different. This is just an example. Look at your private placement memorandum, and we'll talk about that a little later. That will have all the deal information. Get to know your deal sponsor, have those discussions with them so that you know exactly how things are set up. So that way there's no surprises. So we're going to talk about some accredited investor versus sophisticated investor. So this is a lot about the legal must-knows. And this is all extremely important because, as we will discuss, it will determine what deals that you can and cannot invest in. Okay. Then we're going to go into the securities offering table. We're going to really dive into 506B, 506C, and what really all that is by the Security Exchange Commission. We'll go into the private placement offering memorandum. We'll discuss the general versus limited partners and operating subscription agreement. As I said earlier, this is a lot of information, and this is why I'm holding the questions to the end, just because it's a lot. But hopefully it's good information. It at least gets you thinking or asking other questions as you have them. So what is an accredited versus sophisticated investor? So an accredited investor are people that have certain wealth that's been determined by the Security Exchange Commission. And in this case, if you're single and you're making $200,000 or more, and you've shown that you've done that last 2 to 3 years, then you're accredited based on your annual income of $200,000. If you're married or have joint income, $300,000 is the Security Exchange Commission threshold for you to be accredited, or a net worth of at least $1 million, not including a primary residence. So if you've got $1 million with stocks, and I know a lot of my investors are the same, they've made a lot of their wealth through tech stocks, so they're over $1 million on paper with that, and so they're based on the Security Exchange Commission. They are accredited investors. Recently, in the last few months, the Security Exchange Commission has loosened this, and it's a huge benefit. And I hope everybody listening on this call really looks into this, because deals that are going to the accredited investor are deals that the average person, that one, who's not looking, or two, can't because of the financial limitation, are not able to access. So they've come out, and there's several, I wrote a blog on this, so check it out on the website. But one bullet point that I really wanted to point out here is that professional designations, certifications, or credentials can qualify you as accredited. This is a huge game changer for so many people, because they didn't hit that 300,000 or that 200,000 minimum, income, or the $1 million, net worth. So really recommend everybody, if you're not an accredited, look into that Series 7, 65, and 82 license. These licenses, two of them, I believe it's the 7 and 82, you have to be with a broker sponsor, and I believe at Series 65 you don't. I may have those mixed around, but either way, there's one of the three here that you do not have to be with a securities broker, meaning you study for the exam, you take the exam, you pass the exam, and you're an accredited investor. And we're going to talk about why that is a benefit in the next slide, to be an accredited investor. Now, from a sophisticated investor, everybody on this call, at the end of this call, will be a more sophisticated investor ready to invest. And it's because you are knowledgeable and are getting sufficient experience and knowledge to make a decision if it's worth investing or worth the risk to invest. Because real estate investing, with any type of investing, is a risk. Okay. So a sophisticated investor does not meet the annual income or the net worth, or don't have these professional designations, right? But you can still invest while not having that, the net worth and income, right? You just have to show that you're sophisticated enough to look at a deal, analyze it, and determine for yourself if it's worth investing in. And really, all this is good because a lot of people lost a lot of money to Ponzi schemes and other um, bad actors who just, did horrible things with their investors' capital, right? And so the Security Exchange Commission, their goal is to protect the investors as much as they can. And so with a sophisticated investor, you can invest in certain deals. And we're going to talk about that right now. The two most common syndication offerings are typically 506B and a 506C. The 506B and the 506C can have unlimited raise amount. So as I talked about earlier, you can get a $10 million for a $2 to $3 million down payment, just like you would if you're buying a $200,000 house. 10, 15%, 20%, you're able to put enough down to buy that house. Same obviously with multifamily, as we've talked about. There's no limit for investment size per investor. So if you wanted to invest $2 million, $50,000, $10,000, doesn't matter to a security exchange on what you can invest in both 506B and a 506C. Where it changes here, excuse me, is the 506B. If I have a 506B offering, I'm not able to post on Facebook. I'm not able to go out there and do a general solicitation for advertising, okay? Whereas a 506C, you are able to do that. And we'll talk about that shortly on why you can. Going back to the accredited investors, unlimited amount of accredited can invest in both 506B and a 506C. There is a difference on the 506B. Somebody can self-certify, so you don't need a third party to say that you aren't lying about your financials. Whereas on a 506C, you do need a third party to validate your financials, that you are accredited. So this is where it changes. So are non-accredited investors allowed? So for 506B deals, yes, sophisticated investors are allowed in those deals. However, for every deal, and it's deal specific, when I say deal, it's property specific, 35 sophisticated investors can invest in that deal. I can have an unlimited amount of accredited investors, but 35 sophisticated investors. Now, as we talked on the last slide, sophisticated are those that can look at a deal and make a decision for him or herself to know if it's a deal that they want or are interested in investing in. There's another caveat to 506B. You and the deal sponsor have to have a pre-existing relationship prior. So one of the things I've been doing on the blogs and such is like, let's get to know each other. Because if we don't know each other and I do a 506B, you're not able to invest because we don't have a pre-existing relationship. Even though you're sophisticated and such, if we don't have a pre-existing relationship, you can't invest on a 506B. It's also another reason why I recommend passive investors, we'll talk about our meetup later, but get out there and meet other deal sponsors, other people that are sourcing and finding deals, so that way you have an opportunity to invest, because they can't publicly announce to you that they found a deal if you're not an accredited person, right, or a 506B. Now, if I slipped over to a 506C, I can do whatever I want from an advertising standpoint. If you see some ads, I'm sure now that you've typed in multifamily investing, you'll start seeing some ads on Facebook. All those things are 506C, right? And you can get the deal sponsor get in major trouble, legal trouble, if they were doing a 506B and doing general solicitation. So the 506C that you may be seeing, are only limited to those accredited investors if you met that net worth or you had those professional certifications, designations. So that's where it does, change. So 506B is, a lot what we do. It's more, I like the relationships. I know who's investing in the deals. I can do sophisticated, I can do accredited, but I can only do 35. If I'm doing a huge capital raise and it's a say it's a $15 million property, and I've got a $5-6 million raise, likely, depending on the partners that are involved, we're going to be doing a 506C. So look at those designations, professional certifications, so it doesn't limit you on what deals you can and cannot invest in. Okay. This 506B though, if you don't have the accredited designation or certification, meeting the net worth and such, that's okay. There's a lot of great 506Bs. The biggest thing is you've got to get in front of deal sponsors, and you've got to say, hey, I'm such and such, and I'm wanting to partner with you, and build that relationship. It's going to be good for you because you get to know what they're doing and how they structure their deals, and how they are able to deliver and do day-to-day management of that property on your behalf, and such. So hopefully that explained a little bit more about 506B, 506C. I'm not going to go into Regulation A, Tier 1 and Tier 2, but that is here, and you'll have the slide when I send out the recording. So this is probably the most important document that you will read if you're going into these type of investments. And this is called a private placement offering memorandum. I would hope that every deal sponsor out there is providing a PPM to their investors. If they're not, this is something now you need to be asking for. And most, I would say the reputable ones are, right? And this private placement offering memorandum provides you that transparency of what is involved in this deal. What are the splits? Who are the partners? How are the distributions going? What are the risk factors? It gives you all the details, and it's written by, it's through a law firm that they'll put it together, and they'll have all the considerations for you as a passive investor. Now, this can be a 30-page, it can be 100. I mean, depending on the asset and the complexity, it could be a pretty daunting task to read, but it's an important thing to read. And it's something that the PPM typically, unless you are a huge contributor in that deal, cannot be changed. So it either works for you or it doesn't work for you. Okay. But this PPM is a very important document that you will cover. Again, it will cover the conflicts of interest, discuss legal representation. It'll go through all the terms of the offering. If you're not knowing initially that it's a preferred return versus an equity split, or there's waterfall splits, et cetera, that is all going to be put into this private placement memorandum. This is your homework on the side of doing due diligence on that property and making sure the numbers make sense. So now we're going to talk a little bit about a general partnership and an LP. So we talked about what an active investor is and a passive investor. So the active investors are the general partners. Let me back up. General partners and the limited partners together are the legal entity, are the owners of the property. If you go invest into a real estate investment trust, you're buying sort of a stock into an investment, right? Similar to buying a Google stock or any publicly traded stock. Similar thing on the REIT. You're not buying equity into the property. You're buying a share in the company who owns and manages those apartments or that real estate. The benefit of passively investing in a syndication is you own equity. You are an owner of that property. You can go to that property and say, I'm a limited partner, and say, this I own. I have ownership into this property. And it's the truth. Because the general partnership and the limited partnership combined will equal that corporate entity that owns that property. So they're that LLC or the limited partnership. Now the GP on the active, so everything in blue is active. So the general partner, they found the property, they've capital raised, they've signed the loan, et cetera. Their job is to manage the entire deal from start to finish. And what I tell my investors and when I tell others is you should know the strategy of the property that you're investing in before you invest anything. That deal sponsor needs to share their business plan and go from A to Z on how they're going to improve the property, for your money. Okay. So the general partner is responsible for doing that. Now, the limited partner contributes the majority of the funds to finance the deal. And then their job really is passive. They have other interests, they have other jobs. They're not actively on the day to day. Now, does that mean they completely stay away and they don't ask questions or they don't read anything? No, you can be as active or not. You know, whether it's getting a monthly report from the GP of, what's going on, what are some of the market changes, et cetera. Asking questions, going to the property. Those are things that a limited partner can do, right? But they are passive. So at the end of the day, the general partner is the decision maker on the property. So the expectations are the GP, they showed you a strategic plan. Now things can change depending on the market conditions, but for the most part, the business plan is what it is, right? And you implement it. And that's the general partner's responsibility to implement it. There's got to be ongoing communication to the limited partners, and they've got to provide the distributions on time. You're investing your money and you're being told that at month 6, returns are going to start and you'll be getting a 7% return. Well, that 7% return needs to come. And if it doesn't come, you need to have open communication from the general partner on why that isn't and how they're going to do to fix it, and how to get, if it's preferred return, if they don't meet their returns, then future returns are accrued. So you get, caught up. But as the expectations of the limited partner, completely passive, right? Capital's locked in for a hold period. Profits aren't guaranteed. They're at risk. Some financial considerations. So the general partner, they're responsible for the deal's debt. So there is risk, for me signing on a multi-million-dollar loan, there are risks. A lot of the loans on the multifamily side are non-recourse, but that doesn't mean that the lenders can't come out, for you if you were doing something they shouldn't have, et cetera. So there are liabilities from a general partner side about the debt. And then from a limited partner, the money that was put in the deal is the money, that's the max money that person can lose, right? And we're talking about a lot of loss and stuff here. And the nature of it is the historical returns, as we talked about before. Historically, properties, grow in revenue and such and grow in value, but there is risk, just like with anything. Go to the next slide. Got a few more slides here on the operating and subscription agreements. So on an operating agreement, we talked about the private placement memorandum, important document. Now the operating agreement is going to go in and it's going to talk about how are decisions made, about the rules, regulations, because remember, it's a legal entity that owns that property. So that legal entity, because there's a general partnership and a limited partnership, there needs to be rules to govern the internal, operations of the business. And so you'll get an operating agreement. It's a document you should read. And if you have questions, talk with your attorney. But it will be signed by all those that are in the limited liability company. So the GPs and the limited partners that make that limited liability company will sign this document. The other document that you'll see is a subscription agreement. So the subscription agreement is really that two-way guarantee that deal sponsor is going to provide a certain amount of shares to the investment, and in return, you're buying at a certain price. So there's those 3 legal documents: the private placement memorandum, the operating, and the subscription agreements, that are really the 3 documents that you as a passive investment, will review, aside from the business plan that, the deal sponsor is putting together. So just a couple more slides here, and then we'll open up some questions. So on real estate market cycles, this is, if you haven't heard Glenn Mueller, he is a professor at the University of Denver. Every quarter he puts out a report, and I believe this has happened, since 1996. But he goes in and labels certain markets based on these 4 phases. So in real estate, we are not tied to the stock market. It, it's one of the reasons why we invest in real estate. It's not one day it's hot, one day it's cold. It's supply and demand, and you know, it's going through this, like, for example, phase one, recovery. There's, um, you know, during a downturn, rents start going down, below inflation, rental growth. So you're starting in this recovery, then you start getting into an expansion mode where rents start rising. It's usually the time where development starts occurring again. And as you get higher and higher, you start getting into phase three, the hyper supply. And then you have this downward cycle of too much apartments or too much office, and rents are having to decline because you got to stay competitive. You got to attract, new tenants, new residents. And then you start getting into, the last phase four, recession. So it's important because wherever you invest, and there's people, all over the country on this call right now, but it's good to know where your city is and all that. And it's important because when you talk to your deal sponsor, and your deal sponsor is saying that they can get 3-4% annual rents, but because you're a sophisticated investor, that, hey, my city is in hyper supply, or this particular submarket, there's new construction all around it, or et cetera. Those are type of things that you can look and ask the deal sponsor to clarify and understand that they're being conservative. Maybe, don't have to be like super conservative, but at the end of the day, being conservative with the mindset of, are the returns from a rental standpoint achievable? So, in looking at my three markets, so San Antonio is in expansion mode. San Antonio is a city that continues to grow. It benefits from the Central Texas location of being close to Austin, but it also has a lot of its own economic drivers that are there. And the apartments in particular are, they're still in that development. Rents are growing, and when rents are growing, money's there, so there's expansion going, but it's not in that hyper supply. So, a 3-4% rent increase is definitely doable in the expansion cycle. But if you're in Houston or Austin, there is so much development going on in these cities, and good reason, because there's a lot of companies and a lot of growth, in these markets. So they got to keep up with the demand. But all these cities that are in hyper supply, again, may not have the rental growth that your deal sponsor is projecting. And so you just want to look, from a rental side, it's like, hey, I understand this market's in a hyper supply. You're going to be competing. Talk to me about your, your projections on rental growth. Now, when we're underwriting a property in Houston, instead of like a 3%, maybe we're doing a 2 or, even a 1.5 in some markets, that affects the purchase price. So if the deal sponsor can talk through it and it can make sense to an investor of, okay, well, this person has thought about it and they've worked to reduce risk, and it makes sense to me, then, you can understand where, it's like, okay, I feel comfortable investing. And then when you go into recession, these are opportunities. For me, it's like blood in the water, and we're sort of getting there with multifamily now, where, a lot of owners overpaid and they have debt service that they're not able to pay right now. So they're working with the banks and going through, modifications, in some cases forbearance, et cetera. Those are opportunities for some great opportunities to buy. So again, long story, but it's very cyclical. Ups and downs, supply, it's all driven on supply and demand. And that's a huge benefit of real estate investing compared to the stock market, which, one tweet can really destroy or boost stocks, right? So with that said, I do want to share on a couple slides on how to learn more. One is we had a meetup on Monday. It was our best turnout yet. We had about 30, a little over 30 people that joined, 30 investors joined. But we meet every fourth of the month at 7 p.m. It's a different format than this. It's a meeting setup. So we'll have breakout groups in the beginning and in the end, or we have conversations at the end. So you're able to see each other and ask questions and such. So go to the meetup.com / Texas Multifamily Investor Meetup and join us. Next month, we're going to go through how to underwrite, like from a passive investor standpoint. There's not a lot talked about, like how do you, like if you get a deal, how do you do your own underwriting at a high level to make sure it makes sense? So one of our investors that have just joined previous meetups is going to take the lead on that. I feel like it's important from a passive investor side for them to share what they look for to benefit others as they learn. So it will be a great one. Again, the fourth Monday of each month. There's another book here that I recommend. I don't get any money from it, but I think it's so good. I recommend all my investors to read it because it gives you the information to ask questions and make you that sophisticated person. So you can even question me or question another deal sponsor. I think that's a good thing, right? It elevates everybody's game. And so I highly recommend Passive Investing in Commercial Real Estate, Insider Secrets to Achieving Financial Independence. James Kanasami is my mentor, and he's a GP on all our deals. And he really goes a lot into multifamily and deal structures and what to ask when you're dealing with a deal sponsor. So again, recommend that book. The other things to learn more is, I've got a podcast that we do every other week. You can get it at CREIPartners.com / podcast or Apple iTunes. Go on there, but subscribe. We've been very fortunate. I've had conversations with, obviously multifamily, but we've had storage. We've had student housing. I'm about to interview a good friend of mine that's in office acquisitions. So, that's a really good podcast. There's a lot of others, but hopefully I'm adding value to those that are listening, or if you haven't, please do so. And hopefully it helps everybody on the journey of real estate investing. And then I've got my ebook at CREIPartners.com / ebook. So I'm all about, again, just providing knowledge, education, trying to get people aware that you can diversify, that it's not just the wealthy that can invest in these type of deals. Those that are looking for that financial freedom, or I had one guest who 100% lives off passive income from multifamily deals. He doesn't have a job. He doesn't work from, he invested his money into deals and lives off that passive income. So it can happen, and it does happen. And if there's anything I can do for y'all, I'll go into questions in a second, but let's connect. Whether you invest with me or not, no big deal. It's at the end of the day, building the relationship and seeing how I can provide value to y'all, and how we can work together in the future. So please reach out. I'm going to send everybody an email after this, but you can reach me at wayne@CREIPartners.com, or you can call me at 512-710-2500. So with that, I'm going to try to answer some of these questions that have come in. All right. So Nathan, thank you for confirming the Series 65 exam is the one that doesn't require sponsorship by a broker dealer. So yeah, so you don't have to work for an investment firm to get it. So thanks for clarifying that. You should be able to see my contact info on the slide here. And again, I'm going to follow up afterwards. One of the questions came in is it typical to see either preferred return or a cash flow split for LPs, or is it also common to see the pref and a cash flow split? So it's really depends on the deal sponsor, depends on the deal. And I say that because there's got to be enough meat for both parties to be excited about it. Okay. So at the end of the day, if the deal sponsor is able to grow their wealth as well, then it aligns with those passive investors that are investing. So why do I say that? So if it's a higher opportunistic type property, they can't guarantee a 7-8% because there's more opportunistic. It's more opportunistic. There's more risk. So for that, they're going to be doing more of an equity split. Now, what I do see typically on a preferred is typically a 7-8%. What we saw before, 8-9% preferred, that was norm. 7%. If I'm only looking at 8-9-10% cash flow, I'm not going to make any deals because today's market, again, if you're underwriting conservatively, and we're going to talk about that in our meetup next month. If you're going to underwrite conservatively, I rather make sure we have consistent, achievable returns to our investors than overpromise 8-9-10% and then only can deliver 7. So what I am starting to see more so with deal sponsors is 7-8% cash on cash. And then it was year 5 sell. Now it's more year 6, 7. Some deals can sell at year 5. It just depends on the market and location. But then you would have the split, typically an 80-20 split or a 75-25 or 70-30. And those are, one thing I didn't really hit on, but if you're bringing in all the cash, right, and the split is pretty 50-50 with returns and such, then, talk to another deal sponsor. Just make sure you've got the right fit. I think if you're at 75-25, meaning 75% of the total equity profits are going to passive, 25 going to active, the GP, or even a 70-30 or 80-20. I mean, 60-40. I mean, those go to deal sponsors that have had, a lot of say experience potentially, and you're okay with paying them more because, again, it goes back to that risk profile. So good. So one question is, you also hear term cash yield. Is that the same cash on cash? So yeah, it's the rate. It's the same cash on cash, the yield. So it's the return on that. But remember, the cash on cash is the money that you put in divided by the money you've received. So again, if you put in 100,000 and you've got 10,000, then that cash on cash for that year is 10,000. So depending on the deal, you may not get the full 10% year 1, right? It may be a 5% year 1. But if you had a preferred, and I say only 5% because year 1, you're re-tenanting, you're renovating, you're implementing the strategy of the property. But that 5% that you didn't earn that year 1 is accrued into year 2 until you're caught up, right? So that's something to consider. Going through some of these other. Stop sharing. All right, one of the questions was, how does cost segregation affect taxes? So cost segregation goes back to that accelerated depreciation, okay? So that's what that is. And I've got a blog on that as well that really dives into it. But if we talked about before, normal depreciation is over that 27.5-year period. When you hire an engineer, it gets into that cost segregation. They're doing a cost segregation. They're looking at all the different aspects of the improvements on the property, and they're determining, okay, this say cabinets have a 10-year life, or flooring has a 5-year life, et cetera. They're breaking that down. So that cost segregation affects taxes because you can, in essence, maximize your depreciation to offset your income. And it's all on paper. So just because you've made, say, $10,000 on investment cash, on paper, you're showing a negative, showing a loss because you had that cost segregation. So all of our properties have a cost segregation, typically $5,000 to $6,000 a year from the property that's done, but it's worth it for the investors. So is a PPM required or recommended for a JV? So it depends. Like if you're bringing in all the capital, like say, you have 2 partners and it's say it's $1 million deal, or say a $500,000 deal, make smaller, and you're able to bring in your own money, then no, because there's 2 investors, There should be some type of legal document, so an operating agreement, something that if things go south, there should always be something in writing, even on smaller deals, if you're dealing with someone else. So there should always be something in writing. PPMs typically come into play where if you're asking others to be passive on it, then yeah, you would want a private placement memorandum. Or doing any type of syndication, I should say. If you're doing any type of syndication, you should have, at the end of the day, what we want to do is be transparent to our investors. Depending on the number of investors you have, that's a personal decision. Is a PPM required? No, it's not required, but it is something that I think is good and typical. One of the questions was the higher interest rate environment in 3 to 5 years. On our deals, we adjust on our cap rates. We do adjust it going up instead of thinking that cap rates and such are going to go down. And we do that because we don't know where interest rates are going to be. We do know that the Fed has said that they're not going to increase the rate. So, from that standpoint, I think it has helped because it's stable. It's helped lenders and businesses to be more thoughtful over their 5-7 year plans from investments and such. So I don't know about 3 to 5 years. At some point, inflation's going to happen, and interest rates are going to have to start going up. There's got to be a correction. Okay, so I do think there will be a correction. But in the next 3 to 5 years, I don't think it's going to happen in the next 3 years. Maybe longer. There's just so much unknown, politics and such. But it's a good question, and we didn't really go much into the cap rate, and so that's something I'll write a blog about, and maybe we can talk about it in one of our meetups. But it's important because if, say, your cap rate, the cap rate for those, it's a multiple. So you got net operating income, and when you buy a business, there's a multiple that you can multiply times the income to get to the value of, say, the business. Similar in commercial real estate. It's not like your house where it's priced per square foot. This house sold at 183, mine would sell at 183 square foot, et cetera. It's not like that. It's all about net operating income and the cap rate, the multiple for that particular submarket. So if you buy a property at, say, a 5.5 cap rate and your exit cap rate is at 5, then you're being really, really aggressive, in my opinion. And how this all ties together is the interest rates. You got to assume that there's going to be some movement going up. So you want to see that cap rate be at least, a quarter basis point or some more to help offset that risk. Good question. Let me make sure I've got another. All right, I'm gonna give any other questions. Again, this was a lot of information. As you can tell, my voice is going out, but it's a lot of high level stuff. And so let's, take it as, a little bit of everything. Reach out, join our meetups, learn. I'd love for y'all to invest and such, but at the end of the day, it's not about that. It's finding, good deals for everybody to grow their wealth. And to do that, you've got to have some type of knowledge and be sophisticated and look at deals so y'all don't, get into an investment that you wish you didn't do. All right. Again, my number is 512-710-2500. Website, CREIPartners.com. You can reach me through there. So reach out. I'm going to send out an email, and hopefully this was helpful. And then join our meetups. The meetups are different setup. It's definitely more engaging and such. I know this is a lot one way, so I appreciate the understanding, but we are recording this, and I am going to send this recording out. So hope everybody has a great rest of the day or evening, and look forward to hopefully getting to know you better. Thank you.